You should be able to distinguish between conventional versus government-backed mortgages, as well as the different types of government-backed mortgages. Explain the pros and cons of fixed versus adjustable rate mortgages, as well as jumbo and reverse mortgages. Create educational aids to help clients better understand the mortgage market and set your business apart from the rest. There are a wide variety of mortgage loan products available today, with even more variation as to how these products can be modified to tailor to different markets and home buyers. There's enough noise in the mortgage market to confuse a seasoned real estate professional, so imagine how intimidating the mortgage market can be for inexperienced home buyers. We will look at loan types based on three primary either-or designations that tend to be discussed in conjunction with each other. That is, a mortgage falls into either one or the other of each of the three categories. 1. A mortgage is either conventional or government-backed. 2. A mortgage is either conforming or non-conforming. 3. A mortgage is fixed or variable, adjustable. Conventional versus government-backed mortgages. Conventional mortgage loans are issued by private banks and other financial institutions that aren't insured by the federal government. Government-backed mortgages, more often referred to as Federal Housing Association, or FHA loans, are also issued by private banks and other financial institutions, approved by the federal government, but the federal government ensures the repayment of the loan, meaning that if a mortgage holder defaults on a loan, the federal government is ultimately on the hook to pay it back, not the lender. With a conventional loan, the lender is on the hook if the mortgage holder defaults on the loan. Conventional mortgages are typically issued to mortgage applicants with a high credit rating, stable, well-paying income, and low debt. Lenders do not require government backing to underwrite these loans because the applicant is at a low risk to default. FHA loans are typically administered to applicants who don't have as strong of a credit rating, have lower or less stable income, and might have higher debt, thus making them more at risk for defaulting on a mortgage loan. The government insures loans like this to make home ownership more accessible to lower to moderate income individuals, who would otherwise not qualify on their own for a loan with a private lender. Conventional loans typically require at least 20% down payment on the home price, though the down payment range can be as low as 3% depending on the type of mortgage. This is known as the loan-to-value ratio, LTV. Because conventional loans have a lower loan-to-value ratio, as well as the individual higher income and credit ratings mentioned earlier, mortgage applicants for conventional loans typically receive better terms for the loan in the form of lower interest rates and/or closing costs. The terms for an FHA loan tend to be more costly for the applicant in the long term by way of built-in PMI, private mortgage insurance, and additional closing costs and fees that often get rolled into the loan origination. It's important for lower to moderate income home buyers, and often first-time home buyers, to be aware of these costs and how they work. For example, PMI is typically required for any loan that has a down payment of less than 20%, or, put another way, with an LTV higher than 80%. The homebuyer will pay PMI on whatever the difference is. The lower the down payment, which for an FHA loan can be as low as 3.5%, the more PMI the homebuyer will pay over the life of the mortgage. PMI can cost between 3% to 1.5% of the loan amount annually. There are a wide variety of loans issued through the government. We will look at the three most popular here and provide a link to additional loans at the end. Federal Housing Association, FHA, loans. The most popular is the FHA loan. These government-insured loans have for decades made home buying dreams a reality for millions of Americans. Because the government insures, lending standards are slightly less stringent than they are for conventional loans. In addition, borrowers can put as little as 3.5% down, which is particularly attractive to many first-time buyers who may not have the savings to put down more. However, to put down so little, applicants do need a credit score of at least 580. Credit scores as low as 500 can still be issued FHA loans if they are making a down payment of at least 10%. United States Department of Agriculture, USDA, loans. The USDA is not only involved in food safety, it's also involved in helping people living in rural areas buy a home by providing loans at lower rates for those who qualify. The primary focus is rural areas, but there are some suburban areas that qualify as well. In addition to geographic restrictions, there are also income and credit restrictions. The adjusted gross income of the borrower can't be more than 115% of the median income in the local area. That is, to qualify for a loan, there must be some evidence of economic need. Because of this, the USDA loan is one of only two loans that require no down payment. As with other loans, any down payment less than 20% requires PMI, but the USDA loan caps PMI at 1% so it wouldn't prove as costly. The other requirements are fairly similar to other mortgage loans. Applicants must demonstrate a stable income, lower debt, and a relatively high credit score of approximately 640 or better. Veterans Affairs, VA, loan. VA loans are for qualified military personnel, which includes active service members and spouses, as well as veterans. It's important to stress the qualified part here because, in addition to specific forms and documents showing proof of service, to qualify for a VA loan at least one of the following criteria have to be met to be considered an eligible veteran. At least 181 days of service during peacetime. At least 90 days of service during wartime. At least 6 years of service in the National Guard or Reserves. A spouse of a service member who lost their life during active duty. To prove qualification, a certificate of eligibility, COE, is typically required. For clients who are eligible, they can apply online or print out a form from the VA website. Sometimes it can be obtained with the help of a lender, but given that the process can take up to 6 weeks, it's best to have this process complete if the need for mortgage eligibility and approval is immediate. Qualified borrowers will generally get lower rates, better terms, than with other mortgage loans. Similar to the USDA loan, one of the biggest advantages of the VA loan is the opportunity to receive a mortgage with no down payment. Also similar to the USDA loan, there are PMI-like fees associated with putting down less than 20% but at rate that would be less than other mortgage loans. Lenders will look for a stable income, debt ratios, and credit history. The credit rating to qualify for a VA loan is somewhat less strict than for a USDA loan recently. The median score for a no down payment loan is approximately 620. Conforming versus non-conforming loan. Conforming mortgage loans are those that comply with, or conform, to the financing limits and underwriting guidelines set forth by the Federal Housing Finance Agency, FHA, and Fannie Mae and Freddie Mac. The primary criterion is that the loan stays within the federal conforming loan limit, which is established annually. For 2021, home loans that are at or below $548,250 are considered conforming loans, which pertains the majority of the country. However, the price of real estate is not the same everywhere, so there are higher conforming limits set for what's considered high-cost markets. Major metropolitan areas where the price of real estate is very expensive, such as the outlying metro areas of New York City, Washington, D.C., and San Francisco, have a conforming loan limit of $822,375. Conforming loans offer term and cost benefits to the applicant. For one, they are easier to qualify for, but they also typically offer better rates and sometimes lower down payments. Non-conforming mortgage loans are those that do not comply with, or conform, to the financing limits and underwriting guidelines set forth by the Federal Housing Finance Agency, FHA, and Fannie Mae and Freddie Mac. As with conforming loans, there are a number of criteria that determines a loan is non-conforming. A primary criterion for non-conforming loans are those that exceed the maximum limit in a given market. These non-conforming loans are, as a result of exceeding the maximum loan limit, also popularly known as jumbo loans. Other criteria that might deem a loan non-conforming are those issued to applicants with lower credit rating, a high debt-to-income ratio, or down payments less than 20%. Some non-conforming loans typically have less advantageous terms for the mortgage holder, often by way of higher interest rates. A non-conforming loan does not necessarily mean it's a bad loan. The terms for non-conforming loans are typically not as good for loan applicants because they are more difficult for the lender to sell on the secondary market, which is where banks and financial institutions can generate more revenue by buying, selling, and investing in mortgages or packaged mortgage-backed securities. It's important for real estate professionals to educate their clients on what non-conforming loans are, and what they are not. There are non-conforming loans that will be very risky for clients to take on, but there are non-conforming loans that might be a relatively low risk, and perhaps only, ticket to their dream home. Fixed versus adjustable rate mortgage. Fixed-rate mortgages have the same interest rate throughout the life of the loan, that is, the interest rate will be the same for the first monthly mortgage payment as it is for the last. The fixed-rate mortgage can be set with a number of different terms. The most popular, and perhaps what's considered the standard loan today, is the 30-year fixed loan. The next most popular is the 15-year fixed-rate mortgage, but terms can also be set at 25, 20, or even 10 years. With a fixed-rate mortgage, the home buyer has the long-term peace of mind of knowing that the rate is locked in for the life of the loan. There will be no increases over time. However, there will not be decreases in the rate either. For a home buyer with a steady, secure income who is seeking to buy a property to reside in for an extended period of time and perhaps build a family, a fixed-rate mortgage is a sound, lower-risk option. An adjustable-rate mortgage, also known as an ARM, changes, or varies, over the course of the loan. There will be an initial period at the outset of the loan where the rate is fixed, but at some predetermined time in the future, the interest rate will change based on the then current market indices. There are a wide range of ARM products lenders can offer as long as they comply with federal lending laws. The variation often comes in the initial fixed period and the adjustment frequency that follows once the initial fixed rate period ends. Typically, the terms of the loan are stated in the title of the ARM type. The first number of an ARM states the initial fixed period, and the second number states the rate adjustment periods thereafter. The time frame for when the rate readjusts after the initial fixed rate period is often annually, but can also vary. It's far more likely that the rate will adjust at faster increments than a year than slower increments. It is possible, though not likely, that a homeowner's interest rate decreases during the adjustment period, but based on historical data, chances are far more likely that the homeowner's rate will increase, which is what makes ARMs a somewhat riskier loan type for home buyers. If the home buyer has increased their income and financial standing during the initial lower ARM rate, they will be able to absorb the added cost of the interest rate increase. If, however, their financial standing has remained the same or perhaps gotten slightly worse or less stable, then the increased cost could pose significant financial risk. There are many other terms associated with ARMs that are important for home buyers to be aware of as they seek and perhaps qualify for an ARM. Adjustment frequency. The time frame in which the rate adjusts after the initial fixed period of the loan. The rate can change as frequently as every month, but more typically adjust in terms of years, such as 1 year, 3 years, or 5 years.